The first time I hashtag get off zero was 2018 and Bitcoin was $6,700. But, and to your point, it was even before that back in 14, 15, where, I went to my clients, institutional clients for the first time, first quarter of 14, and they're like, you're an idiot. Don't talk about that. That's just stupid. People just need to get off zero. It is time. I mean, this is going to be the most powerful movement, both in terms of people, volume, value, that we've seen so far. And each successive one will get bigger. That's the law of large numbers. But it's going to be powerful. So join us.
As per a filing disclosed to the United States Securities and Exchange Commission, Fidelity has entered the fray as the latest financial powerhouse seeking approval for a spot Ethereum ETF. The filing outlines a proposed rule change that, if accepted, would enable the exchange to list Fidelity's envisioned Ethereum fund. It's worth noting the striking resemblance between this proposal and Fidelity's prior spot Bitcoin ETF proposal, which was submitted to the Commission in June. In justifying its proposal, Fidelity points to the recent ruling in the Grayscale case, where the court admonished the SEC for lacking a clear rationale and rejecting spot crypto exchange-traded funds. Notably, Grayscale, in response to the SEC's rejection of its spot Bitcoin ETF application, pursued legal action and emerged victorious in a legal battle that compelled the SEC to review its decision. The timeline for these developments is significant, with Mark Yusko expressing optimism about a potential surge in liquidity and the initiation of a bull market within the next 6 weeks, as stated. He encourages preparedness among investors for what he anticipates as a pivotal sequence of events. Yusko's positive outlook adds a layer of excitement to the unfolding developments in the crypto space, underscoring the importance of staying vigilant and ready for potential market shifts.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
Everybody's coming. Literally everybody. And first couple weeks of January, kind of the kickoff for our London event. BlackRock ETF is going to get approved. Hundreds, plural, hundreds of billions of dollars are going to go into Bitcoin. And that's going to trickle down through the ecosystem and the digital age will be here. And the thing about it is we've been talking about this, right? 2024 is the 14-year cycle. And it's only 6 weeks away. I mean, we are 6 weeks away from the beginning of this powerful 14-year tech cycle with, blockchain at the core. And I'm super psyched. I said at this conference in New York, and it's like making the rounds on Twitter, I said, look, there's actually a chance. They quoted me as saying it will definitely happen. I said, there's actually a chance that Bitcoin could become the base settlement layer for all global assets. And everybody's like, and then there's other people. Oh, of course. That's what we've been saying all along. Maybe not, but okay. But here's the thing. People who are, ETH heads are like, no, there's more transactions on ETH. I'm like, that's not what I said. I said the ultimate settlement layer for the highest quality assets likely will be the highest quality chain. How do you judge quality? I don't know. Uptime, lack of hacks, security. Okay. So you can make a case for both, but at the end of the day, what I see happening is the highest value digital assets are migrating toward Bitcoin. That's interesting. And it doesn't mean you can't have, to your point, other systems that do other things and even have monetary use cases, but they won't be money. Like if you believe, as I do, that Bitcoin has won the war for digital gold, right? That it is a better form of gold. It's equally scarce and more divisible and more portable. And therefore it will replace gold as that base layer. Then we can abstract all we want on top of it. And it's not going to be without a fight, right?
While markets may be speculating that the Federal Reserve's anti-inflation rate hikes campaign has concluded, At least one official remains unconvinced. Susan Collins, president of the Federal Reserve Bank of Boston, expressed a differing stance from several of her fellow officials who recently addressed the public. During her CNBC interview on Friday, Collins acknowledged her encouragement by recent data indicating that consumer price increases are decelerating more rapidly than initially anticipated. However, she diverges from prevailing trader sentiment, which heavily leans towards the expectation of the Fed lowering its benchmark interest rate from its current 22-year high in the coming months. Collins advocates for patience and resolution, emphasizing that she wouldn't rule out the possibility of traditional firming measures. She underscores the need for a holistic examination of the data. Amidst these deliberations, Mark Yusko shares his insights on the potential rate cut, inflation trends, and the trajectory of interest rate hikes, as mentioned. As we delve into the macroeconomic landscape, Yusko's perspective promises a comprehensive understanding of the interconnected factors influencing decisions related to interest rates and inflation.
You and I have been talking about this literally for a year, and we said that, that inflation that everybody was worried about actually wasn't inflation. My view has always been it's never been inflation. It's never been excess demand for limited supply of goods. It was always currency devaluation, which caused oil prices to rise, and the lockdown, horrible policy decisions, which messed up the supply chain, which made used car prices go up, for a short period of time. All of that is now gone the other way, and we're back to where we were. And yet the market reacts to it like it's some massive amount of good news. And, I think we're up 10% plus in November here in equity markets. Now, I'll explain why that is. And again, we talked about this a few weeks ago. It isn't inflation. It isn't anything other than the November effect, which used to be called the January effect. And it's the fact that, people sell all their bad stuff in October. When I say people, meaning the mutual funds, they have to sell before October 31st for their fiscal year. And then they have to wait 30 days to buy it back. So that's been moving, or it used to be, right before October 31st. Then it was like October 15th. Then it was like the first couple weeks of October. And so what was happening is there was this rally, then 30 days later in first part of November. And everybody said, oh, it's the Santa Claus rally. It's like, no, it's not the Santa Claus rally. It has nothing to do with Santa Claus. Santa Claus is a mythical person. But this has to do with real people buying real stocks 30 days after they sell them for tax losses. And that's what's happening, I think, in the markets. And there were a lot of people who were short, who got caught offsides, just like the Bitcoin rally. People were short and they got caught offsides. And so we got this big rally. And then they misinterpret this. We're at 3%. And Professor Plum, Mike Green was on a clip I saw on Twitter. It was kind of funny. He's like, people do realize that 3% means prices are still rising, right? They're rising less than they were the month before and 6 months before, but they're still rising, right? I mean, people do understand that, but I guess not. I never like to disagree with Paul. With Paul Tudor. No, with Stan Druckenmiller. He was talking to Paul Tudor Jones, but I just don't like to be on the other side of investment legends, right? But I just vehemently disagree with this whole idea that inflation is going to go to high single digits. Look, I think inflation is driven by working age population growth, and working age population growth stinks. It's headed to sub 1%. The boomers keep aging every day. 10,000 more of us turn 65. I still got a ways to go, but it's going to happen. And that I just think we're going to be much more in a deflationary environment than an inflationary environment. And look, the 2% number, it's just the theft target. There's no normal reason for quote unquote prices to rise just because. prices should rise when demand exceeds supply. That's economics 101. But this idea that by increasing the money supply and therefore devaluing the currency, because that's all this inflation target really is. It's a devaluation of currency target. And the big spike and the expectations lag the reality. So these expectations weren't before the Fed printed all the money. It was after the Fed printed all the money. And then magically people were shocked, I tell you, that the prices of things and the quote unquote value of things went up. And we've talked ad nauseum about this. They didn't. My house did not get more valuable. It just didn't. The money got worse. And now, for the first time in 100 years, they're restricting the money supply. They had negative money supply growth for the first time in 100 years.
Since the commencement of 2023, Bitcoin whales have consistently been accumulating, resulting in addresses now holding over 1,000 Bitcoin amassing a total of 7.66 million Bitcoin. Meanwhile, the Federal Reserve has maintained a notably silent stance on any regulatory updates for the cryptocurrency market. The growing unease surrounding this silence prompted Vice Chairman for Supervision, Michael Barham, to make assertive statements regarding the crypto market. Michael shared his perspective on stablecoins and the broader impact of the crypto market on financial markets, expressing concerns about their historical volatility when not subjected to regulation. He emphasized that while stablecoin innovation should be allowed, it must occur within well-defined regulatory boundaries. Discussing the potential impact of crypto market volatility and recent downturns on traditional markets, Michael reassured that the banking system has not been deeply exposed to cryptocurrency risks. This, he attributed to the cautious approach most banks are adopting toward digital assets. Despite the absence of a clear regulatory roadmap from the Federal Reserve, the need for cryptocurrency regulation is repeatedly underscored. Nevertheless, crypto investors remain largely undeterred, maintaining optimism for a potential rally. The highly anticipated approval of spot Bitcoin exchange-traded funds, expected in January of next year, adds a bullish element to this optimism. Notably, whales have seized the opportunity in this climate, consistently accumulating over the past 11 months. Year to date, these addresses have amassed more than 120,000 Bitcoin, valued at over $432 billion, underscoring their confidence in the potential for significant profits amid a potential Bitcoin price rally. The question lingers, will the predicted bull run commence in 6 weeks, as Mark Yusko anticipates? Share your thoughts in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.